Ghabour, co-founder and owner of Key Advisors Wealth Management. Eddie, always good to see you.
Thank you.
It looks like you might be lowering your cash exposure and buying some of these dips, I see. Not a bad time, obviously, with stocks near record highs, to think about what to do with your money. What do our viewers need to know?
So right now, the biggest focus has been on when the Fed's going to cut rates, and because that's obviously going to be something that is closely watched. And you're still getting a lot of mixed signals. You got a hot inflation number, and then you got weak retail sales number today. So there's a tug of war between the consumer weakening, yet the inflation problem not going away. And we don't think it's going to go away. So investors just really need to focus on the momentum right now in the equity markets. We know that the markets are not the economy. Obviously, if we do have a recession, the market will react to that. But I think it's safe to say this year, and traditionally election year is a pretty strong year, as we said going into last year, that we were going to start buying the dips that we saw this first quarter. So I think you're going to continue to see some gyrations here in the first quarter of this year. We have inflation data coming out tomorrow that could certainly cause things to increase volatility, and we're going to keep buying those dips. But I think investors should focus on the areas that haven't participated as much as other areas, because in our opinion, for this market to stay strong this year, which we think it will, at least through the election, you're going to see things broaden out. So we bought small caps on dips in January. We bought some mid caps internationally. We're in India right now.
Interesting. I know you joined me earlier this year, and this pretty much does align, Eddie, with what you were expecting then. You've been a guest on our show for a long time, right? And you have indicated that sometimes we can see pullbacks in the first quarter. Is that a seasonal factor, a cyclical factor? How do investors look at that?
So I think, you have to look at it differently each year based on what the setup is. And the setup for this quarter was we were really overbought, in our opinion, coming into January. And we did see that little bit of a pullback. And now once we get through NVIDIA's earnings next week, you're just going to be seeing a weak seasonality in conjunction with an overbought market. Even right now, as we're bullish here short term, we are overbought. If NVIDIA has great earnings, you could see another spike going in the next week. And then after that, I think you're going to see that volatility into that seasonality between mid-February and towards the end of March. That'll provide a lot of buying opportunities for investors. And then I think once you get past the first quarter, you're going to see potentially a Goldilocks type scenario in this market heading through the spring and summer until we get to the election.
Okay, very good to know. In terms of people looking at their own asset allocation, Eddie, what would you recommend to them to make sure that their portfolio is in the right shape?
So obviously everyone's risk tolerance is different. For the fixed income side, we are finding some yields on ETFs that we have in our portfolio of over 8% with not a lot of volatility, which is a very handsome dividend yield for clients that want some stability. And then on the equity side, internationally, we are in India. That's our only international exposure. And then domestically, you're still going to want to stay where the areas of strength are, which is still going to be technology and semiconductors. But to my point earlier, we want to be buying for our clients small caps on dips because they're still 20% off their lows. We think that there's a lot of upside potential there, as well as healthcare and industrials. These are areas that haven't had a lot of strength, and they're starting to pick up some strength here going into this year. So that's kind of how you can barbell your portfolio in regards to staying with what's hot, but also buying things that haven't participated as much as the other asset classes, because we think they potentially can have a big year.
So it sounds like, Eddie, you think, right, the broader the breadth, I think many people would say the more confident they are in the economy, the more confident they are in a stable stock market. Yes, we have seen technology, certainly last year as well, on all that AI hype, really kind of lead the pack here. But what I'm gathering based on what you're telling me is that a soft landing is probably the likely outcome, and that the economy does look like it's in pretty good shape. Is that the case?
I would say short term, okay? And here's why I say that. We still have lots of outliers that we're worried about with the amount of consumer debt and government debt out there. I just think that they've been able to leverage up because the labor market has stayed tight, that we're not going to have that recession here in the near term. for this year. But we think we have to be very tactical here. We've told our clients everything we buy is going to be on a short string, meaning if things deteriorate quickly, we will sell out. We're not just going to buy and hold blindly.
Yeah.
But based right now, next year is probably going to be when more of these headwinds really start to come to fruition.
And walk me through what some of those headwinds could be that investors should know about.
So one major headwind is if we see a reacceleration of inflation. You know, the consensus is inflation is coming down and the Fed's going to be cutting rates. And we've seen some signs where that inflation number may stay sticky. And if it reaccelerates, that's going to be a big problem, where now we may be talking about the Fed raising rates. I hope that doesn't happen. However, if we do see that reacceleration of inflation, that narrative is going to be discussed. The bigger problem is the debt bubble we're in. We have a record amount of debt on the consumer side, and we're now starting to see companies laying people off. Every week, you're now starting to see major companies lay people off. So if that unemployment rate starts to go up, then those folks are going to have a hard time paying that debt. They're able to pay it while they're employed, but if they're unemployed, that's when you're going to start to see the debt bubble implode. And that's our biggest risk and our biggest fear is the amount of debt that's in the system right now.
And how does that impact the stock market?
So look, the stock market traditionally, whether you have a mild recession or a hard recession, generally you should expect a 20 to 30% sell-off there. So if we see a big acceleration of unemployment and we are heading into a recession next year, the market will front run that, and it won't discriminate. As we've lived through over the last 25 years of doing this, you'll see a broad-based sell-off that will happen, and you'll start to see the long-end rates start to come down as growth really starts to decelerate. Again, that's not something we're worried about here in the next 6 to 8 months, but it's still on our radar as we continue to focus on the consumer and the labor market.
Talk to me more about the India bet. Eddie, we had talked about this a little bit last time you were on earlier this year, but for investors watching, wondering, maybe I should get some exposure to India. Why does India stick out when it comes to broader international markets that you feel confident enough to just focus on that country?
So we bought India last June, and fortunately the timing of that was good. It's been a great investment for our clients. And the reasoning behind that was because of the move that we're seeing in some of our companies here like Apple and Amazon, where they're really taking business away from China and investing in India. And we see that trend continuing. And when you look at their economy right now, one can make an argument that it's the best economy around the globe. They're growing at about a 6% GDP. And their inflation is at pre-COVID levels. So they're just booming right now. And if that trend continues, where you see companies starting to continue to invest in India because of the strong demographics and because of the fact that they see the risks now with being in China, that they're starting to diversify where they're trying to have their manufacturing and product development. And so we think India could be a multi-year story in regards to growth. And another thing that we like about it is not all day, it does not lock in with the S&P, meaning it's not directly correlated. We've had many, many days in the last 8 months that we've owned it where we've seen a lot of outperformance, and it's a way to diversify in something that is not correlated to the U.S. markets.
All right, Eddie Ghabour, always good to have you on the show. Thanks so much for joining us.